Discounted cash flow overview. A discounted cash flow is used to calculate the value of a business based on all future cash flows that the asset generates. It is an intrinsic calculation of value. In other words, it is not dependent on the relative value of other companies. A discounted cash flow is the summation of all future cash flows discounted today using the following formula. Project out 5 years of cash flows plus a terminal value. Then discount each of those 5 cash flows and the terminal value to today, add them together to get your discounted cash flows. The terminal value. The terminal value represents the value of a company's cash flows into perpetuity. You assume all the cash flows are the same or they grow at a steady state rate. There are 2 generally accepted methods of calculating the terminal value. One is the Gordon growth model and the other is a terminal multiple. Using the Gordon growth model, the terminal value for cash flows 6 through infinity is equal to the cash flow in year 5 multiplied by 1 plus the terminal growth rate divided by R minus G. R representing the discount rate and G representing that growth rate. Since we're using cash flows 6 through infinity, this will give you the terminal value discounted for that period to year 5. The terminal multiple method. It's more common used by Wall Street since it's simpler and much faster to apply, but essentially you use a multiple on your last year's operating statistics. For example, you take a multiple EV over EBITDA to year 5 EBITDA, and that will give you your terminal value. How to calculate the numerator. There's generally 2 types of free cash flow. It's levered and unlevered free cash flow. If you're trying to solve for the enterprise value, i.e. the value of the whole business, you use unlevered free cash flow. If you're trying to solve for the equity value, you use levered free cash flow. The levered free cash flow takes out the interest expense owed to the debt holders so that the residual cash flows goes to the equity holders. The unlevered free cash flow is cash flow to all holders of the business, thereby solving for enterprise value. Unlevered free cash flow is calculated as EBITDA less CapEx, taxes, and changes in working capital. Levered free cash flow is your unlevered free cash flow less your interest expense. How to calculate the denominator. The denominator is WACC, the weighted average cost of capital, which is the weighted average cost of each form of capital in the business. Generally speaking, it's the weighted average between your debt and your equity. Note that the debt is tax affected as the cost of equity is already an after-tax number. If there are other instruments in addition to plain equity and debt, you take the weighted average of those instruments as well. For example, the cost of preferred stock. Below is the formula for WACC. Cost of equity. The cost of equity is calculated using the capital asset pricing model, or CAPM. It's the risk-free rate plus beta multiplied by the market risk premium. The market risk premium is the rate of the market minus the risk-free rate. Beta is the sensitivity to the market. So for example, if a company has a beta of 1, it means that as the market moves up, the company's stock price will move up in a proportional amount. A beta of 2 will mean that the company will have twice the amount of movement relative to the market. A negative beta means that it's inversely correlated with the market. Values for beta usually range between -1 to 1, but can be higher depending on how volatile a stock is relative to the market. Cost of debt. The cost of debt is the weighted average interest rate for all the debt outstanding for a firm. The cost of debt is generally lower than the cost of equity, as debt is more senior to equity, will get paid out first in a bankruptcy scenario, and has collateral. Remember, the equity is the residual value to shareholders after the debt holders are paid out. Discount your cash flows to get present value. Once you have calculated your cash flows, projected out 5 years, your WACC for your discount rate, and your terminal value, discount each of your 5 cash flows plus your terminal value to today, The summation of all that will equal your total discounted cash flow value. This should be the enterprise value if you're using WACC and unlevered free cash flows. Like, comment, and subscribe for more content. Also, visit our website at www.wallstreetsmart.com for additional resources.